Greetings and a warm welcome to this week's edition of 401k Real Talk. This is Fred Barstein, contributing editor at wealthmanagement.com's RPA Omnichannel and CEO at Trow, TPSU, and 401k TV. I review all of last week's stories and select the most important and interesting ones, providing open, honest, and candid discussion you will not get anywhere else. So let's get real. First story, in a move already sending shockwaves throughout the financial services world, Merrill's largest group by far, with $129 billion based in Atlanta, left the wirehouse to become independent, known as Open Arc, working through Dynasty and Schwab. With 100 employees and 95 of the top 1,000 companies as clients, and majority owned by senior management with a minority stake now by Dynasty, which in turn has a minority interest by Schwab, Open Arc is well positioned through its stock option, employee benefits, and retirement capabilities, as well as wealth, to leverage the convergence at the workplace. As expected, Merrill filed a lawsuit, but a judge refused to grant a restraining order. Does the move say more about Merrill than the wirehouse model? A senior Open Arc exec stated that corporate clients have indicated that traditional brokerage models no longer meet the needs of their people. Instantly, one of the largest RIA firms, Open Arc may attract other wirehouse advisors or give them the courage to also go independent, though most will still want that big paycheck and move to another wirehouse. Next story, one of the original robo-advisors started in 2008, now with 88 billion AUM, 1.3 million customers, and expected revenue of over 300 million in 2026, Wealthfront has filed for an IPO. In 2022, UBS agreed to buy Wealthfront for $1.4 billion on the heels of the $1 billion acquisition of Personal Capital by Empower, but that deal quickly fell apart. Unlike competitors like Betterment, with 60 billion AUM and estimated revenue close to 200 million, Wealthfront does not work with human advisors. They see themselves as a tech company first and may be able to leverage AI to meet the growing demand for financial advice, which may in turn interest the public. Next story, while PE firms have seen their highest number of liquidity events in Q2 of 2025 at 215 and $308 billion, the news is not entirely good. Concerned about interest rates and the effect of tariffs, many firms have been willing to sell at discounted prices, sitting on 30,000 companies waiting to be sold and 35% held for more than 6 years acquired when interest rates were lower. PE has heavily invested in the DC world, most recently Stone Point and the Canadian Pension Plan, which also owns Ascensus, bought One Digital. Madison Dearborn, which also owns Great Gray, repurchased the wealth and retirement assets from Aon, and Aquiline is divesting SageView at a discount. Other aggregators like Hub are owned by PE, while CapTrust and Creative Planning, which is acquiring SageView, have taken minority interest. TPA firms continue to be acquired by PE-owned entities. The current number one concern by PE firms? Fundraising, which may be why many like Apollo, Blue Owl, iCapital, and KKR are focusing on DC assets. Next story. Empower's Ed Murphy is certainly not shy or afraid to make bold statements, declaring recently in an interview with Star Wealth Management reporter Alex Ortolani that his firm is on the hunt to buy a national RIA firm. While still looking to acquire other record keepers, Empower's focus after the MassMutual and Prudential deals seems to be on advisory firms, buying Personal Capital for $1 billion in 2021, which now has $100 billion, growing at 25% annually, and 1,000 advisors leveraging Empower's 19 million participants. Adding a national RIA would only accelerate that growth, though it may raise concerns by advisors that bring them the plan and look to leverage participants themselves. Finally, Mark Twain once said that history doesn't repeat itself, but it often rhymes. Driven by consolidation and convergence, record keepers, asset managers, and advisory firms are looking to rebundle services, reversing the unbundling of the DC industry over the past 25 years. Read my recent wealthmanagement.com/RPA column about how bundling service is more about owning the participants, not the plans, as the fee gap is widening. And last but not least, this week's LinkedIn poll asked which team will win the World Series. Most picked the Dodgers, followed by the Yankees, Brewers, and Blue Jays, though after the first two games with the Blue Jays, the Yankees seemed overmatched. So those are the most important and interesting stories from the past week. I listed a few others I thought were worth covering, including TPAs need to embrace AI, growing number of plans join the Portability Service Network, the ARA comments on the DOL's PEP RFI, 10 big changes coming to the 401k and IRA markets, and Leaf House CEO weighs in on the data dilemma. A final note, I usually cover the job reports at the beginning of each month as it affects how organizations view benefits like retirement plans. But because of the government shutdown and the chaos caused by the firing of the BLS commissioner after a job report that Trump claimed was rigged to make him look bad, the September job report has been delayed. Trump's initial nominee for BLS Commissioner, E.J. Antoni, has been withdrawn after bipartisan concerns. Please let me know if I missed anything or if you'd like to comment. Otherwise, I look forward to speaking to you next week on 401k Real Talk.